We'll now cover section 2.2, which is forward markets. The first thing to understand is, what do we mean by a forward exchange rate? And this is something you've seen in level 1 derivatives and level 1 economics. So essentially this is a review. A forward exchange rate simply means that if you are sitting here at time 0 and you want to buy a currency at the end of 6 months, the transaction will take place over here, but at time 0 you want to lock in a rate. So you want to create a contract or an agreement with a dealer saying that you want to buy 10 million US dollars on 6 months from today. So that exchange rate that is quoted at time 0 for a transaction that will occur in the future is called a forward exchange rate. So take a simple example. Let's say that you want to buy 10 million US dollars and you are in Pakistan. So you are going to buy 10 million US dollars in terms of Pakistani rupees. If the dealer quotes you a rate of rupees 100 per USD, so rupees 100 for 1 US dollar, this is a forward rate. The spot rate might be, say, 94 rupees to the dollar. So just to hammer in the point, the forward rate is the rate that you agree upon at time 0 for a transaction that will occur in the future. Now, how do we figure out this forward rate? And the answer is, we figure it out using a formula called the covered interest rate parity relationship. And the way it works is quite simple. The forward rate is equal to the spot rate multiplied by 1 plus an interest rate in the price currency divided by 1 plus interest rate in the base currency. So I'll put P for price over here and B for base currency over here. Now this illustrates an important point. Whenever you are looking at exchange rates, you need to be very clear about the base currency and the price currency. We talked about this in the earlier segment. So if you have an exchange rate that says rupees 94 per $1, then obviously the dollar is the base currency. Base currency is the currency of which you have 1 unit, and the rupee is the price currency. So anyway, the base currency interest rate always goes in the base or the denominator. The price currency goes in the numerator. The next point is that if the interest rate quoted is on an annualized basis, and that actually is what will normally happen, then you also need to adjust for the number of days. So if this forward contract over here is a 6-month forward contract that corresponds to 180 days, and let's say that the interest rate in the price currency is 12%, so that's the interest rate in Pakistan. So I'm going to get back to this number in a minute, but the point is that the interest rate in the price currency needs to be adjusted based on the number of days. So if this is a 6-month forward contract, we multiply the interest rate by 180 over 360. And this is the base currency, US dollar. So this also needs to be adjusted based on the number of days. So essentially we are taking an annualized rate and then adjusting it based on the maturity of the forward contract. So to understand this fully, let's plug in the numbers. The forward rate for a 6-month contract on the US dollar will be as follows. If the spot rate is 94, then the forward rate would be 94 multiplied by 1 plus the interest rate in the price currency, which is 0.12. This needs to be multiplied by 180 over 360 and divided by 1 plus the interest rate in the base currency. Let's say that's 2%. So 0.02, and this also needs to be adjusted based on a 180-day or a 6-month contract. So when we do the math, we will get the 6-month forward rate, and note that the forward rate is going to be higher than the spot rate. So when the base currency has a low interest rate relative to the price currency, then this fraction obviously is greater than 1, and that essentially means that the forward rate is going to be more than the spot rate. In this case, we say that the base currency is at a premium relative to the price currency. Key point here is to remember this relationship, the covered interest rate parity relationship. The curriculum spends a lot of time going into the intuition behind this. We have already seen this earlier, so I don't think we need to get too hung up with the details. From an exam perspective, just remember this formula. If you really want to get into the intuition, do the following. Actually, the point here is that this is the relationship that ensures no arbitrage. If you use any other forward rate, then there is a arbitrage opportunity, and you can play with some numbers and convince yourself of that. But for now, just remember this relationship. We will use the covered interest rate parity relationship to do example 2. We are given the Canadian dollar Australian dollar spot rate. We are given the 270-day interest rate on the Australian dollar and the 270-day rate on the Canadian dollar. So what is the forward rate? The first thing you do on a question like this is to be clear about the base currency and the price currency. So given the convention that's being used in the curriculum, we say that Canadian dollar over Australian dollar is equal to 1.0145. This is the base currency, and the Canadian dollar is the price currency. So essentially we are saying that 1 Australian dollar is worth 1.0145 Canadian dollars. So let's just write down the covered interest rate parity relationship, which says that the forward rate is the spot rate into 1 plus interest rate in the price currency adjusted by 270 over 360, because we are looking at a 270-day forward contract, and this is divided by 1 plus interest rate in the base currency into 270 over 360. Now let's plug in the numbers. The spot rate is 1.0145 into 1 plus interest rate in the price currency. The price currency is the Canadian dollar. Canadian dollar interest rate is 1.41%. So we put in 0.0141 multiplied by 270 over 360, and this is divided by 1 plus. Now we have interest rate in the base currency. The base currency is the Australian dollar, interest rate 4.87%. So we put 0.0487 into 270 over 360. If we do the math, what we will get is 0.9891. So essentially this is saying that the 270-day forward rate on the Australian dollar is 0.9891. Example 1 asks us about the forward premium. Now forward premium is equal to the forward rate minus the spot rate. So in this particular case, the forward rate we have calculated as 0.9891. The spot rate is 1.0145. So the forward premium is equal to minus 0.0254. When we have a negative premium, this is also referred to as a forward discount. So we can either say that the forward premium is minus 0.0254, or we can say that the forward discount is 0.0254. Now, note the following. When the base, so in this particular case, note that the base currency has a relatively high interest rate. So the base currency is the Australian dollar, that has an interest rate of 4.87%. The price currency has a relatively low rate. So whichever currency has the higher rate will lose value or depreciate. So here, since the base currency has the higher rate, it is expected that this is the currency that will lose value, and that's what we are seeing over here. Now let's take a look at Exhibit 1 in the curriculum, which is very important, and this shows us how forward rates are typically quoted in professional FX markets. So Exhibit 1 tells us that the spot rate on the US dollar / euro, so here the base currency is the euro, the spot rate is 1.3549 / 1.3651. This is the bid and this is the offer. What that means is, as we've discussed earlier, if you go to an FX dealer, he will buy the base currency, i.e. the euro, for this much, and he is willing to offer or sell the base currency, i.e. the euro, for 1.3651 US dollars. So this is the spot rate. Now the forward rates are quoted in terms of points relative to spot. So if the 1 month forward point is minus 5.6, this is on the bid side. So to figure out what the 1 month forward rate must be, we convert the points into decimal and add to the spot rate. And note that even with forward rates, just as with spot rates, we will both have a bid and an offer. The bid represents the price at which the dealer will buy from you, and offer represents the price at which the dealer will sell to you. So as we see in the curriculum, let's compute the all-in forward rate for a 3-month contract. I use the term all in, and I'm going to explain in a little bit what that means, because the curriculum keeps using this term. Now we are given the spot rate, or the spot rate. Let's just take a bid. Let's say that we are interested in selling to the dealer. So the bid rate means the rate at which the dealer will buy, so that means the rate at which we will sell. If we sell in the spot market, we sell euro for this much. But what if we are interested in a 3-month forward contract? So if we sign a 3-month forward contract, what will be the 3-month bid rate? The way we do that is, this is a number that tells us the forward points. To convert forward points into decimal, we need to divide by 10,000. So to convert into decimal, we say minus 15.9 divided by 10,000. The point here is that if our currency is quoted in terms of 4 decimal places, then we need to divide the points, in this case 15.9, by 10,000. Notice the 4 zeros here corresponding to the 4 decimal places. So in decimal terms, minus 15.9 points is equal to minus 0.00159. And then to compute the all-in forward rate on a 3-month contract, we simply take the spot rate, which is 1.3549, and then adjust based on this number. So minus 0.00159, and you come up with 1.3651. 1.35331. So notice that the forward rate is lower than the spot rate, which is what you expect given that we have a negative number for the forward points, and we can tell based on this that the base currency is expected to weaken. So this means that the interest rate on the base currency must be higher than the interest rate on the price currency. So the all-in rate, as you have probably figured out by now, is simply the forward rate where the forward rate has been adjusted based on the forward points. So the 3-month all-in forward bid rate is 1.35331. If you look carefully at Exhibit 1, you are given the 1-month maturity, you are given the forward points for a 1-month contract, 3-month contract, and then there is also a 6-month contract and a 12-month contract. On the 12-month contract, the forward points are minus 94.3 slash minus 91.8. Now you will notice that the bid offer spread widens as the maturity goes up. So I can write it very simply like this: as the maturity goes up, the bid offer spread also becomes wider or goes up. And the curriculum gives us 3 reasons for this, which I think you should remember because this is a potential question on your exam. The 3 basic reasons for why we have this relationship are as follows. Number 1, typically the liquidity in the forward markets tends to decline as the maturity goes up. So since the liquidity declines, the spread goes up. The second point is the exposure to counterparty credit risk increases. So exposure to counterparty credit risk goes up. That also causes the spread to widen. And finally, the interest rate risk of the contract increases, and that also causes the spread to increase. So just remember those 3 points and you are in good shape. Now let's talk about the concept of mark-to-market value of forward contracts. And this statement here describes the concept well. Mark-to-market value of forward contracts reflects the profit or loss that would be realized from closing out the position at current market prices. So recall from level 1 that the value of a forward contract at time 0 is equal to 0. In other words, when you get into a forward contract at time 0, neither party owes the other party anything. So the value of the contract at time 0 is 0. But over time, as currency exchange rates change, then some party is going to make a loss and the other party will make a profit. So let's look at the simple example from the curriculum where we have a 6-month forward contract on 10 million pounds, and the price currency here is the Australian dollar. So we are given this information: 6-month forward contract, 10 million pounds, and the all-in forward rate is 1.6100. Let's say that we are taking a long position on the pound, which means that we are going to buy pounds for 1.6100 Australian dollars per pound. So we are sitting here at time 0. We are getting into a contract to buy 10 million GBP for 1.6100. 3 months into this contract, we want to mark to market. So to mark to market, the way we figure out the value is what would be the profit or loss that we would realize at this point if we close out our position. So how do we close out our position? We close out our position at this point by getting into another contract again against GBP. So at this point in time, if we get into a 3-month forward contract, because now only 3 months are left, So 3-month forward contract to sell GBP. And let's say that the dealer quotes us a rate of 1.6340. 1.6340. The curriculum gives us a spot rate, and it also gives us 3-month points. So based on what we've just learned, we can easily calculate this all-in rate based on the spot rate quoted, which is 1.6210, and the 3-month points, which equal 130. So we need to convert the 130 into a decimal and then add to 1.6210. This is exactly what we just did. Now, given that we are going to sell pounds, obviously we need to look at the bid rate, because our selling pounds means that's the rate the dealer will buy at. So essentially these two agreements, the agreement to buy pounds for this much on this date and the agreement to sell pounds at this rate on this date, essentially means that we are cancelling out or closing out our position. So if we were to close out our position over here, do we make money or do we lose money? The answer is that we make money. So how much money do we make? Given that we can buy a pound for 1.61 and sell a pound for this much, that means that on a per pound basis we can make 1.6340, that's how much we are selling for, minus 1.6100, that's how much we are buying for. And since the contract is for 10 million, we multiply this by 10 million, and that gives us 240,000 Australian dollars. So when we close out our position, we know that our profit after 3 months is going to be 240,000 Australian dollars. But we are marking to market at this point in time. So we need to take the 240,000 Australian dollar profit at the end of month 6 and find the present value over here. So to find the present value, you take this number and discount based on the interest rate. The interest rate obviously is the Australian dollar interest rate, since that's the currency we are using over here. Let's say that the interest rate is 4.8%. So to discount back, you will do 1 plus 0.048 and adjust this for 90 days. So into 90 over 360, and this will give you Australian dollars 237,154. So that is the mark to market value. And again, coming back to our original statement, our mark to market value is 237,154, because if we close out our forward contract over here, that's effectively the profit that we make. And note that when you go long on a currency, so in this case we went long on the pound, our contract is going to give us a profit if our base currency appreciates. So notice that the number went up from 1.61 to 1.6340, and since the currency is strengthening, that's why we have made a profit. Now, based on this information, what I want you to do now is example 3 in the curriculum. So this is a really good example. It has 5 questions, and these 5 questions are based on the material we have just discussed. You must do this because this question is very important from an exam perspective.